Thank you very much. This is my first Noosa conference. I was guaranteed warm weather, but you can't believe everything that stockbrokers tell you. We all know that. When Rob Ward from Morgan's Melbourne office asked me to speak at this conference, I asked him, what did he want me to speak about? And he said, make it retail friendly. Like, when's the next wave coming? What should investors look for in a project? What do big companies look for in value? What is your outlook on the commodity cycle? He finished by saying, you've got decades of experience. How is it relevant to the retail investor? And he finally finished with the encouragement, you must have done this dozens of times, shouldn't be a problem. I said, well, thanks very much, Rob. I was reminded of the time when I was a junior geologist in Broken Hill in 1970. The mine manager was looking to develop a drive to transfer ore between the Zinc Corporation and New Broken Hill Consolidated. And his instructions, like Rob's, were very simple. He said, keep it straight and keep it in ore. Quite a challenge in a highly metamorphosed and contorted ore body like Broken Hill. I thought I'd start by looking not from the perspective of an investor, but rather the opposite end, the perspective of a director of a public company. The role of a company director is to guide and grow the business, always acting in good faith in the best interests of the company. To do this, of course, they need the support of the shareholders, the providers of capital. So what sort of shareholders do directors look for? Of course, we'd all like long-term, patient investors out of the mould of, say, a Warren Buffett. But realistically, the time frame of investors and the companies seldom match. At the recent APIA conference, the Chief Executive Officer of Woodside referred to this when talking about the huge LNG projects in offshore Western Australia. These projects cost tens of billions of dollars and have a time frame measured in decades. Investors, even in large companies like Woodside, have a time frame more like 3 to 5 years. There is clearly a mismatch in time frame between companies and investors, and even more so in companies in the business of exploration and development. Ours is a very high-risk business. Failure is common. Good news and bad news often follow on the heels of each other, resulting in a cohort of investors quick to excite and easy to frighten. In this environment, directors' duty of care and loyalty cannot be to every investor at any moment in time, but to the company and to those willing to stick around for at least a period. To attract such providers of capital, directors need to show prudent allocation of funds and preservation of capital, which really, I think, goes to the core of strategy. So this really brings me to the first point about investing in exploration companies. You need to choose those that have a clearly expressed and easily understood strategy. No company can look for everything anywhere and everywhere. Even industry leaders like BHP, Rio Tinto and Woodside need to have focus in their exploration programs. Large companies need to be focused on projects which, if successful, would have a material effect on their bottom line. Smaller companies need focus on the commodity sought and the geographical location in which they seek it. So my thinking is to avoid companies that have projects looking for phosphates in Morocco, gold in West Africa, copper in South America, because they cannot hope to be successful. Too many projects without clear focus on exploration nearly always lead to death by 1,000 cuts. You'll forgive me, I hope, if I use my own company, Karoon Gas Australia, as an example of a company with a well-expressed strategy. I'll just give you a moment to read that. But Karoon has been quite a successful explorer by following that strategy, a strategy which really is about area selection, being where the oil is. Don't be out there in the frontier, in the areas where no man has ever found oil yet. And to use your in-house technical expertise in working up the areas, and then your commercial skills in being able to farm it out such that you end up with a good residual interest in an eventual discovery. The next thing to look at in an exploration company, in my mind, is its track record. What has been their record in doing what they've set out for themselves to do? Now, exploration is an industry in which the participants are prone to some exaggeration of the merits of their prospects and their own track records. It has ever been thus. As Mark Twain remarked when he visited the Californian gold rush in the 1850s, out here is a mine is a hole in the ground with a liar standing next to it. I think we always need to remember when looking at claims in the involvement of discoveries that success has many fathers, failure is an orphan. However, there are prospectors and companies that do seem to have more than their share of luck. And again, if I can refer to my own company, Karoon, it has a 68% record in drilling successful exploration wells, which is very high by oil exploration standards. Turning from strategy and track record, what should an investor be looking at when considering the merits of a junior mining company? And I think a key factor is the commodity which they seek. There are more than 100 elements in the periodic table, but in reality only a few commodities are the province of exploration and development companies. In mining, gold is by far and away the most common, and 70% plus of junior miners are involved with this commodity. The price of gold, like currency exchange rates, is fraught with difficulty in predicting, and despite the best efforts of the explorer, a change in gold price has brought many undone. And I think if those of you who may have attended Michael Knox's talk of yesterday, the economist from Morgans, it was quite sobering, his reflection on what may happen to gold price with the strengthening of the US economy and the US dollar. A couple of years ago, with gold hovering around 1,600 US an ounce, there were many hopefuls and a particular concentration on the part of Australian juniors on the Birimian-hosted gold deposits of West Africa, in places like Ghana and Côte d'Ivoire and Burkina Faso. 2 years on, the price of these companies is a fraction of what they once were, and their seemingly once economic deposits remain in the ground. Through really no fault of their own. One thinks of Perseus, Zuma, Griffin, amongst many other companies that were and are exploring there. In general, with junior mining companies, I'm inclined to concentrate only on those looking for the usual run-of-the-mill metal commodities, copper, nickel, lead, zinc, silver, and probably uranium. And I would be inclined to ignore those spruiking a commodity or wonder metal you have never heard of, or commodities which are byproducts of the main metallic elements. I'm thinking here of rare earths, collectively or individually, cobalt, molybdenum, and especially byproducts of byproducts. There was, for example, a company several years ago spruiking the high price and incredible properties of rhenium, a super alloy component. Total world production, 70 tonnes. The problem with byproducts is their production is incidental to the production of the main metal and therefore not related to cost of production. Then there are the bulk commodities, iron ore, coal, both thermal and metallurgical, and bauxite. By and large, these are the province of the industry leaders like BHP Billiton, Rio Tinto and Glencore Xstrata. But at specific times, certainly not now for iron ore and coal, and in specific situations, usually associated with quality and location, these can be a profitable undertaking for a small company. The agricultural commodities, like potash and phosphate, are difficult to make an economic development even for a large company. Think of the Duchess phosphate deposit. How many has that sent broke? And in general, are no place for the junior. Look at the problem BHP Billiton are having with their much vaunted and promoted fifth commodity, potash. The Jansen mine in Saskatchewan is now estimated to be a 15 billion development, and they keep on making new estimates and new studies. And how many phosphate hopefuls have there been in Australia, mainly in the Cambrian in northern Australia, with success so far being very elusive? While sulphide nickel is a good commodity in which to invest, lateritic nickel is to be avoided like the plague if a processing plant is to be built. I can't think of one of these that has ever been able to make a return on the capital invested anywhere in the world. Remember, here in Australia we have Murrin, and there were two others, the names of which I've forgotten, but where everybody broke their pick. A direct shipping project based on laterite is a different proposition, but such projects are very hard to find, and Indonesia, to the benefit of nickel price, it should be remarked, has banned them. So having sifted through the commodities being sought by a junior, the investor needs to be concerned about the nature of the mineral deposit they might have. Whether it's a prospect or a resource in the process of being defined, the starting point, in my opinion, is grade. Nothing can beat grade. And what you are looking for in considering grade is the answer to the question, would this prospect be economically developable if there was enough resource at this grade? Mineral deposits have to have continuity and grade to become ore bodies. Deposits are found by drilling, and drill holes must have ore grade intersections. You are never going to turn a 0.2% body of copper mineralisation or a 0.2 grams per tonne gold mineralisation into an ore body, no matter how much of it there is. And you can pretty much forget justifications of commerciality based on an accompanying rare wonder metal or a gang mineral like pyrite or magnetite or hematite, which the promoters say could be concentrated and sold. What you need are reasonable intersections of ore-grade mineralisation showing continuity over reasonable strike lengths. In thinking about ore grades, you could look at grade multiplied by metal price to get a feel for raw rock value. Grade multiplied by volume, and to pick a specific gravity, 2.8 probably is a good number to get a feel for how much of it there is. Location, which goes to the cost of development, and depth below surface, which will determine mining method and thereby cost, are also important factors in deciding whether or not what somebody has might be commercial. Also, size is important in determining commerciality because it will determine who might buy the prospect on the basis that sale to an existing miner is a quicker and safer way to guarantee a return rather than the junior developing the project themselves. And when you look at something like Sirius Resources, where they've had this amazing, very quick move from discovery into the start of development, but still they have made a poultice of money there really by allowing it to be taken over by another company rather than waiting around for the cash flows to come from the development themselves. A resource of several 100,000 tonnes of contained copper metal or nickel or 1 million ounces of gold is most probably likely to interest buyers. So size is quite important there. It's also quite interesting that a company doesn't always need to discover something to become a successful miner. Look at Fortescue Metals, the so-called new force in iron ore. It has become an ASX 100 company by essentially recognising a market opportunity and laying claim to deposits in the Pilbara thought to be too low grade for development by the two established miners there. The development of coking coal in Queensland by Utah Development in the 1960s is a very similar story. Timing is always important in investment, and other speakers have shown this slide of the life cycle of a junior explorer. Really a graphical expression of something Owen Hegarty quoted in his opening address, and that is, when you can see the bandwagon, it's usually too late. And also, I think something we should say about this particular slide is that not all the companies recover from the so-called orphan period or valley of death, and recovery is not always back to the heady levels following the initial discovery announcement. Our industry is prone to what Alan Greenspan has referred to as irrational exuberance. This really brings me to where are we in the mineral cycle today? And again, a slide that we have seen other speakers use. And this I took from an article that appeared in The Australian, and they credited, I think, Line Selection with having been the people who came up with this clock. And they showed something that I think earlier speakers have spoken about, how, we're at 4 o'clock, just after the crash and at the start of the boom. However, the trouble with the clock is that it does not keep constant time and can stay in any quadrant far longer than one can anticipate. Also, the clock keeps different time for different commodities. Clearly, we've been through a commodity super cycle for the past 10 years, largely based on the rise of China. We've seen some commodities, most notably oil and iron ore, pushed up to stratospheric levels that have enabled higher cost resources to come on stream and lead to oversupply. And I'm thinking here of the US oil shale producers and the aforementioned Fortescue as prime examples. It is not unique in the world of commerce, not just for mineral resources, that the reason for the end of the boom is oversupply. Even the coffee shop in the high street goes broke because of oversupply due to the many imitators that have set themselves up to enjoy the success of the first one or two. Demand for mineral commodities today has never been higher, and the projections for demand in virtually all commodities is increasing as far into the future as we can think about. The difference in mineral commodities is perhaps the lumpy nature of supply. The projects which dominate supply are large, and it can take a long time for the supply to work off. Look at LNG. There are 7 projects underway in Australia right now, and when they are complete, Australia will be the largest LNG supplier in the world, surpassing even Qatar. These projects are enormous. The Chevron-led Gorgon is an investment of more than $45 billion, and their size and incremental expansion capacity will tend to cap price for some time into the future. However, it is inevitable that the down cycle will come to an end, though when that will be is impossible to accurately predict. As the German saying goes, alles hat ein Ende, nur die Wurst hat zwei. Translated, everything has an ending, only the sausage has two. Thank you very much.